All right, well, good morning, everyone, and welcome to today's webinar, Simple Strategies for Finding Hot Stocks and How to Avoid Stock Market Crashes. I'll talk for 45 minutes to an hour as I go through my methodology for how I've approached the market for the last 30 years. I think you will find it very informative. We'll keep it simple. You don't have to have some expertise in finance or even the stock market, really, because I'm going to show you very simple ways to know the difference between a good stock and a bad stock and how to find those stocks that have the best potential. Now, of course, we all want to avoid those stock market crashes. If we have our retirement portfolios, it's always real important to stay clear of those big dramatic sell-offs, and I will show you a very simple way to do that and just give you some skills that you can take forward into forever, really, as long as you're involved in the stock market. Now, this is a first in a series of 4 webinars, and so we'll have more coming up on Wednesday next week on day trading and swing trading. So for those that have an interest in short-term trading, I'll do that on Wednesday. For those more interested in managing their retirement portfolio, those longer-term trades, we'll do that on Thursday. And then for those who want to learn about my tools and different strategies and that sort of thing, we'll do that next Saturday, so 1 week from now. I encourage you to attend all of them. You'll learn something at each one, but you will see some common themes as we go through the presentations. And I think it's time to let's get started. All right, so simple strategies to find hot stocks and avoid stock market crashes. Let's get right into it. So what will you learn today? Well, I'm going to show you a method for you to be able to analyze any stock or market in 10 seconds. And really, with practice, you can do it in even quicker. It's a simple approach that I've developed over the last 30 years. I've been a professional stock trader for over 30 years. And I've taught others my approach for over 20 years. And I know many of my old students are here again today and always looking to learn new things. You'll learn how to spot upcoming market weakness. In fact, there was a little bit of a signal this week that I'll talk about later on that should warrant a little bit of concern. I don't think it's a major concern, but we'll take a look at that as well. And you want to know when a weak market is going to recover. Now, right now we have strong markets, but inevitably there will be weak markets, and there's always that opportunity to know when to start buying aggressively in the market again, and I'll show you some methods for that. I'll show you the key characteristics of strong stocks and how to spot them. And there's a very simple concept that I've built indicators around, and really my whole approach to the market around this simple concept, and I will teach you that. How to avoid big losses. Risk management is absolutely essential in the market, and so we have to have a method for avoiding big losses, because as a trader, our number one goal should be capital preservation, and I'll talk about a way to do that that should make some good sense. And then finally, at the end of the presentation, we'll go on a little hunt for the next hot stock. We're going to run a market scan on my Stockscores tools in search of stocks that maybe have some good potential. So we'll see if we can drum up some opportunities for you guys to consider for next week. All right, so that's the itinerary. Let's get right into it. What we're going to begin with is the basics of stock analysis using my approach. And it involves using charts, but I don't like to be considered a technical analyst, because I really believe that fundamentals drive how markets move. Markets don't go up because of a stochastic indicator or the MACD indicator. Markets go up, or stocks go up, because they have an improving business, or at least the perception is for an improving business. And so what I will do ultimately is I look what people are doing with their money based on the information that they have. Fundamental information about a company's ability to make a profit in the economy or in their business is what drives their stock performance. And when new information flows to investors about the company's ability to make money, that's what drives people to want to buy aggressively or sell aggressively, for that matter. And really what I do is I look at the evidence of what people are doing by looking at a stock chart. And so to do that effectively, you really only need to understand the things that you see on screen here. This idea of inflection points, and then putting those inflection points together, we'll learn how to spot optimism versus pessimism, understand ceiling prices and floor prices, which is support and resistance, understand the concept of price volatility and why that's so important to predicting when a stock is going to make a big move. And then, of course, the most important factor is abnormal activity. And then we'll talk a little bit about trend and why that is an important concept as well. So let's start with some charts, and I will begin by teaching you those 6 critical things, and it all starts with inflection points. So this is a chart of a stock that's done quite well. If you were listening to me on the Michael Campbell podcast recently, today as I do this just after his podcast has run, one of the areas we talked about was uranium stocks, and it's one of the strong areas in the market right now. And this is one of the better stocks in the market right now, Cameco Corp. It's listed on the US exchange as well, CCJ on the US exchange, and on the Toronto exchange, CCO is the symbol. And it's a great chart pattern, and it really captures all of the things that you need to learn. And so let's start with this idea of inflection points. So what is an inflection point? Well, it's the price point where price stops going up and starts going down. So that would be an inflection point high. It's the peak, it's the little mountaintop. Now we also have inflection point lows when the market goes down and then stops going down and starts going up. That is an inflection point low. And so this is an inflection point high, and this is an inflection point low. And you can see as we go through this chart, there are many inflection point highs. Any little peak on the chart would be an inflection point high. And all you got to do is look for places where price changed direction. So it was going up, it stopped going up and starts to go down. All right, so that's inflection point highs. And then of course, the lows, just look for the little valleys where price changed direction, stopped going down, started going up. Now then we can draw a line across those points and define optimism and pessimism. And this is so important because we don't want to be buying pessimism. We don't want to be fighting against the trend of the market. And we can tell the trend of the market or the general feeling among investors, whether it's optimistic or pessimistic, if the bottoms are rising or if the tops are falling. Now in this chart, we really have a situation where the bottoms are rising, and so there was optimism building on this stock from the middle of 2021 until roughly May. You can see this consistent cycle of rising bottoms. Now what that means is that the buyers were getting stronger. Okay, so every time there was a new low inflection point, it was higher than the previous one. And that meant in the war that goes on in the market between buyers and sellers, there's this battle going on. And of course, buyers buy because they think the stock should go up, and sellers sell because they think the stock should go down. And when one side is winning, price goes up. If the buyers are winning, price goes down if the sellers are winning. What you can see though is that every time the sellers were winning, they weren't as strong as they were the previous time. And the result is that you have rising bottoms. And so that's why we can say that rising bottoms are a sign of optimism. And that's simply because investors are getting more optimistic over time. All right, so that's optimism. Now, pessimism would occur when there was falling tops. We don't really have much in the way of falling tops in this chart, maybe a little bit there and a little bit there and a little bit there, but that was in the context of a longer period of rising bottoms. All right, so that's optimism and pessimism. Pretty simple. Start with inflection points and then just connect the dots. Now, the next thing we need to understand is support and resistance. And this has a lot to do with inflection points as well. Resistance is a line, a ceiling price that the market has not been able to break through for some time. So again, if we think about the market being a place where people are arguing about what a stock is worth, resistance is the maximum price that they will pay for the stock given the current state of the fundamentals. So investors look at, how the business is doing. In this case, it's a uranium stock, so it has a lot to do with the price of uranium, the demand for uranium. And for, many years, basically from here backwards, the market said, we don't think this stock is worth more than $40 a share. And it held up for a very long time. Now, along the way, there was floor prices, which we call support. So anywhere that you had an inflection point low, you had a little floor price. So for a while, the minimum amount that anyone was willing to accept for this stock was $25. And then the floor rose. Then it was $30. And then the floor rose again, and it was $34. So that floor price, which we call support, represents the lower boundary of what the market thinks the stock is worth. Okay, it's the floor price. All right, so now we've taken inflection points and we've expanded to 4 important concepts: optimism and pessimism, support and resistance. Now the next one is a little bit more difficult to see, and it's price volatility. And so when I say price volatility, what I mean is how much price is changing over time. And so here you've got some volatility because the market is moving up, and here you've got some volatility because the market's moving down. If we were to sort of draw how this trend has gone, it would look something like this. That's a very simplification of the trend. Now, if I draw a line across the bottoms and a line across the tops, what I can see is that those 2 lines are converging toward one another. What that means is that the volatility over here is less than the volatility over here. Here you have uncertainty. The reason the stock is volatile there is because investors are more uncertain about what the stock is worth. Is it worth $20? Is it worth $35? We're seeing a lot of volatility in that time frame, and that was back in late 2021 into 2022. But over here, we have much greater confidence. So here we have confidence about what the stock is worth. And we can say that because the volatility is less. The range now is between $34 a share and $40 a share. So the market's really saying, based on all of the information we have about this stock at this time, which was early in 2023, first half of 2023, based on all the information we have about the company's fundamentals, about the price of uranium, about the demand for uranium, we think this company is worth between $35 and $40 a share. Whereas over here, it was a much bigger range. Okay? We want situations where there is confidence. Because the next concept that I'm going to show you is abnormal activity. Now, abnormal activity is any time you get a price gain that stands out on the chart. And it will often come with stronger than normal volume. So for example, back here, you had an abnormal gain. Now this is a weekly chart. Okay, so each one of these bars represents a week of trading. So here you can see that the minimum price that week was about $27 a share, and the closing price that week was about $28 a share, roughly. Okay, so it had a pretty good gain that week. It moved from $23, $24 to $28. That's a 20% gain that week. And you can also see that the volume that week was higher than normal. Now there's other abnormal weeks here. There's some abnormal activity there. There's some abnormal activity there. There's some abnormal activity there, of course, there. And this last week was pretty abnormal for price gains as well. Now, because this is a weekly chart, sometimes the volume doesn't show up. You can see the volume was a little higher there, was a little higher there, but oftentimes the strong volume may only be on a single day. And, we're looking at a weekly chart, so sometimes the volume gets a little bit lost. I'll show you some other charts where the abnormal volume gets a lot more obvious. Okay, so we've got the 6 things that we need to understand. We've got optimism and pessimism. We've got resistance and support. We've got low volatility versus high volatility. And we've got abnormal activity. We're going to put those 6 things together to identify the best opportunities. Now, the last thing I will discuss is trend. Trend is pretty simple. You just do what you did for optimism and pessimism. So there you can see we're in a very shallow upward trend, and now it's gotten steeper. All right, so that's trend. Within this little shallow upward trend, we had minor downward trends. There's a little downward trend there, a little downward trend, a little downward trend, but the overall longer term trend was up. Now, if you're a longer term investor, you're just managing your retirement portfolio, really you care about the longer term trend. If you're a shorter term trader, then you can make money in these little trends as well. And yes, we can make money when the trend is down. It doesn't always have to be up. We just have to be able to predict which direction it is likely to go. And that's what I'm here to teach you today. All right, so we've got our 6 things. We've got our trend figured out. Let's look at another chart just to drive these points home again. Here you can see this is Eldorado Gold. And this time, instead of looking at a weekly chart, we're looking at a 30-day, 30-minute chart. Concepts are the same. What's different is how quickly you trade these stocks. So when you're looking at a 30-day, 30-minute chart, you're looking for a trade that may last a few days to a few weeks. We call this swing trading. Okay, when we trade off of the daily or the weekly chart, which was our last one, we call this position trading. This is what you would tend to do maybe in your retirement portfolio where you're not watching it a lot. You might check your portfolio once a week. If you're doing swing trading, then you're probably checking your portfolio or your trades a few times a day. And then we do day trading, where we are really actively trading the stock. I'll show some examples of that later in the presentation. Now on EGO, we had low volatility here compared to here. We had optimism, we had optimism because the bottoms were rising. We had low volatility. We had a resistance price here. We had an abnormal price gain right there. So you had an abnormal price gain from low volatility, from optimism, through resistance. Now you're probably starting to get a hint of how we're going to pick good stocks. Now I'm going to show you how to pick good stocks in a minute, but first I want to show you how to avoid stock market crashes. So we're going to take those same methods and apply them to the overall market to figure out when a stock market crash is coming. Markets do not crash overnight. The fastest crash I have ever seen was the COVID crash in 2019. That was by far the quickest, but even that, you had a week to get out of the market before the majority of the weakness happened. Most crashes build over a few weeks or even months. So this idea that, the stock market is so dangerous and you can watch your money evaporate overnight, really doesn't happen. You know, even when we had the market crash around 9/11, the market had actually already broken down and started to move lower before 9/11 happened. Now, I don't know if that's a coincidence or if people involved in organizing 9/11 were shorting the market and anticipating the problems that were coming. I think that's quite possible. But regardless, I've never seen a crash happen overnight. Maybe if we got attacked by aliens, that might happen. All right, so the market tends to predict crashes, and impending weakness that's coming, leaves clues. And to see those clues, you need to understand reversal patterns and trend lines. Now, as traders, the simple thing that we should always do is trade with the trend. It's like paddling a canoe on a river. You can paddle with the current, or you can paddle up current. And of course, paddling up current is a lot harder than trading with the trend by paddling with the current. So we're always going to think about what is the trend of the market and trade in that direction. And as I said earlier, we can make money from markets going down. There's now ways to do that that are very simple. You buy an exchange traded fund that is inverse of the market. And so if the market's going down, our inverse exchange traded fund goes up. And there's other ways, but that's the simplest way. So you can always make money in any market. The hardest ones are actually the sideways markets. But even in a sideways market, there will be pockets of strength elsewhere. So you might have the overall market going sideways, but perhaps gold stocks are going up, or biotech stocks are going up, while the majority of the market is going sideways. So if you can learn how to read the trend and then trade with the trend, you're well on your way to success. So a trend reversal happens when you break the upward trend line from a falling top, and a downward trend reversal happens when you break the downward trend from a rising bottom. This is always easier when we look at a picture. So here is a chart of the S&P 500 going back to 2019. Sorry, I said the COVID crash was in 2019. It was actually in 2020, right there. And then we had this little bear market in 2022 as interest rates were rising. So in the last 5 years, those have been the sort of critical negative markets that we've seen. And all you had to do was draw a straight line with a ruler to see when the trend was broken. And even the little weakness that we had in the middle of 2023 was anticipated by drawing a line across the bottoms, across those inflection points. And when that line was broken, it told us weakness was coming. There's our trend line in 2023. In the fall of 2023, we broke the trend line, and we then went lower for 2 or 3 months before the downward trend line was broken, and we started to move up again. And so we've had this great rally since late in 2023. You didn't have to know anything about economics or business or what companies are doing. Just draw lines. Works really well. The COVID crash here, okay, that was the first week of weakness. And you saw a pretty good drop there, so you were definitely not getting out at the highs, but it also meant that you avoided the bulk of the weakness. And then the downward trend out of the COVID crash was broken roughly 2 months later. And we got one of the great bull markets that I've ever seen out of the COVID crash. Probably the greatest market was 1999 into 2000 when we had the tech bubble. But the rebound from the COVID crash was, in my career, the second best rally I've ever seen. It was just consistent across the board, stocks just generally going up. Okay, so if we were now to just think about trends and how to trade with the trend, if you're in an upward trend, if the bottoms are rising, in the market. Market's broken, you can be out of the market or in inverse ETFs. And then back into the market, ride the trend for almost 2 years, out of the market. Or buying inverse ETFs, draw a trend line into the market early in 2023. Took a little while for it to get going. You suffered for maybe 2 months before it started into the upward trend. Upward trend line broken, okay, get out of the market or go inverse for 3 or 4 months. Buy the market back and up it goes. And that's really easy. And I do this every week. And so if you monitor my YouTube channel, every week I do a video where I tell you the trend, and I've predicted all of these reversals. So I encourage you to subscribe to my YouTube channel if you're not already subscribed, because it's free. And I will show you these things, not only for the S&P, but for oil, for gold, for Bitcoin, for the bond market, the Canadian stock market, the US stock market. I analyze those each week. All right, so that is how we trade trends. And we can trade short-term trends and long-term trends. I'm looking at a weekly chart. So this is the long-term trend on the weekly time frame. But there's little micro trends inside something like this where we can trade off of the daily, or if you're a day trader, we can trade off of the 1-minute chart using this sort of analysis. Here is the daily time frame of the S&P 500. And you can see we had that daily upward trend broken in August of 2023. Falling tops held up until November of 2023. Go back to my YouTube videos in middle of November 2023. It's all there. And that's when I decided time to be bullish, looking for a Santa Claus rally. And we got that. Had a little bit of a quiet start to 2024, but then resumed the upward trend. But this is the area that I'm a little bit concerned about. And I said at the top of the video, I'd show you the reason for some concern is because on the daily time frame on Thursday, we broke this daily upward trend line. Now it's not a critical breakdown because it's on the daily time frame, not on the weekly, but it does set up for maybe a couple of weeks of weakness or maybe just sideways trading. So some caution warranted based on the daily time frame. Now again, the weekly chart, which is this one, is still intact. But if we had another really strong down week, let's say next week or in the next couple of weeks, we may get a little pullback like this. Okay. All right, so that's how we're going to avoid crashes. That's how we're going to trade with the trend. Now, how do we find hot stocks? Well, I kind of gave you some clues. Abnormal price gains are the critical component. I would say that 90–95% of really hot stocks, market-beating stocks, start their price gain with abnormal volume and abnormal price movement. However, not all abnormal price gains or abnormal volume mean that the market's then going to have a market-beating trend. So we know that most market-beating stocks start with abnormal price activity, but not all abnormal activity leads to strong price gains. So we need a way to qualify the activity that we see, and that's where we're going to apply the chart reading skills that I just showed you. We're going to look for stocks that are breaking from low volatility, through resistance, from optimism, from low volatility. We're going to find the stocks that surprise the market with strength where they were previously boring. Here's an example. I want you to focus on this day right here. And now let's work backwards through that list that I just gave you. We had a line of resistance, a ceiling price right there. We had rising bottoms, which meant we had optimism. We had abnormal volume. We had low volatility and the abnormal activity. So abnormal activity through resistance, from optimism, from low volatility. And since that point, which was just early in March at $1.15 roughly, the stock basically doubled as of Friday, and then it started to move down. It's actually given a sell signal on Friday. Now, I have no idea what this company does. but the market does. The people that know the most about this company, the people that follow it the closest, they're the ones who are buying aggressively on these breakouts through resistance from low volatility, from optimism. And I just follow what they do, and you can as well. The key is being able to find it, and I'm going to show you at the end of the presentation some tools for how we find these. And we'll do some scans, we'll try to find some. So stick around till the end. I'm going to show you exactly how I find these. All right, let's look at another example. This is a swing trade. Okay, this is where we're holding a stock for a few days or weeks. Now I want everyone to just take a moment, look at this chart, and try to pick the point where the abnormal activity started. And I said started, that's critical. Because here you can see the volume is about this level, and then it jumps up. And the price is pretty boring, starts to have some rising bottoms there, and it comes alive. That was the first day that I bought CGC. Now I know that this is a cannabis company, but I don't know anything about what's going on. I just trust that the people who know the most, that are closest to this industry, are the ones that are going to buy aggressively when they know that something's coming. Now, as it happens, one of the reasons why this and all the cannabis stocks went up so much is cannabis was legalized in Germany on April 1st. There's April 1st. The market anticipates things before it happens. Now, there's other speculation that cannabis may not be, or have a change of classification in the US from being a dangerous drug to a less dangerous drug, I think there's some legal classification. And that's another reason why the market's been moving up. And there's speculation that other European companies countries are going to legalize it. So all of these things are what drive the market action. Now, I could study this stock, I could study this industry, I could know everything about it. I could spend hours and hours and hours learning about this. And if I did, I might be a buyer back here because I would know more than most people. But that's too much like work. Why not just follow the people that do all that work? When they know something good is coming, they'll tell me. Now, yeah, I'm not going to be a buyer here before it starts. I'm only going to be a buyer there when it starts. So I'm coming in one step behind the people that know the most. But I'm 10, 20, 30 steps ahead of the public. I'm going to be part of that smart group, and I'm going to sell to the public at a higher price. The people who are buying up here are pretty late to the party. Now, the people that bought here, yeah, they still made money. People that bought here, they're break even. The people that bought early in the day on Friday, they're now losing because this is a 30-day, 60-minute chart. So this shows how prices change from March 1st until now as of Friday, April 5th. Okay, we got one more. This is a day trade. This is a stock that we traded in my active live service, which I run every day, where we look for these things in real time using my tools and indicators. And I've got a couple of computers that are quite powerful that look for these things before most people find them. And so this stock I had on my watch list right from the open. Why? Abnormal volume, abnormal price movement. This is a 2-day, 2-minute chart. So each one of these little bars represents 2 minutes of trading. So this one was at 12 o'clock Eastern until 12:02. All right, and what was important is that right from the start of the day, it was abnormal. It was trading abnormal volume, abnormal price change. And so I put it on my list, but I didn't buy it at the open. I'm waiting for the signal where it breaks through resistance from optimism, from low volatility with abnormal activity. Well, I know that it's got abnormal activity. I can see the optimism building. I can see the line of resistance building. I can see the volatility compressing, and then boom, right there is the breakout. At $2.51 was the price at that moment. That was just before 11 a.m. Eastern time. Look what happened by the end of the day. This doesn't happen that often where a stock makes a gain like this, but there's a couple of these kind of trades a month. Some in a hot market, you'll get a couple of these a week, but this was the hottest stock of last week for sure. 250 to 750 before the trend was broken. And we often neglect the sell side. So let's talk about the sell side. We always want to think about trend. And so you draw your line across your bottoms. That's your trend line. As the line gets steeper, you get what we call a parabolic trend. When trends go parabolic, you get much more aggressive on the exit. And so when this parabolic trend was broken, that was a pretty good reason to take the money and run. Now the linear trend, which is our straight line trend line, is still intact, but I don't want to wait for it to fall all the way down to that price. So I'd rather sell and think about buying back if it comes back to the trend line and then gives a new entry signal. Now I've got very specific strategies for when to buy, when to sell. I'm giving you the high level stuff. On Wednesday next week, we'll talk more about day trading. On Thursday next week, we'll talk more about investing. On Wednesday, we'll also do swing trading. So day and swing trading on Wednesday. Thursday on investing for those who don't want to sit in front of their screens during the day. And then on Saturday, I'll go into the specifics of how I can teach you this stuff. Now, one of the most important things to being a successful investor or trader is capital preservation, risk management. We have to avoid taking big losses. What that means is we have to plan to lose on every trade. Now you hear that and you probably think, what is this guy talking about? Why would I plan to lose if I'm in the stock market? Well, the reason is quite simple. You will never be right all of the time. I've done this for 30 years. I have losses every week as an active trader, day and swing trading. I have some losses every week, but I don't take big losses. And it's really, in investing and trading in the stock market is a numbers game. If I do 10 trades and I make money on 6 of those trades, if I was in school, I'd get a C grade, 60%. But in the stock market, if I make money on 60% of my trades and my average win is 3 times the size of my average loss, then I am profitable. Because if 6 out of 10 times I make $3 and 4 out of 10 times I lose $1, after 10 trades, I'm making $14. Now we can add a couple zeros to this and say 6 out of 10 times I average $3,000 profit and 4 out of 10 times I have an average loss of $1,000, I'm making $14,000. Do 100, 1,400, whatever. The only thing that differs then is your size of your positions. In order to do this, to have small losses, we have to plan the loss and let that determine our position size. And so the way we plan our loss is we look for support on the chart. Now at the top of the webinar today, I talked about support. I talked about a floor price. And the floor price occurred at the last inflection point low. So we're going to trade with the trend. We're going to be very wary of chasing parabolic trends. And when we buy, we're going to plan to lose if the stock goes below support. So let's use this as an example. This is BCE. It's been a dramatic underperformer the last year. And there was an abnormal price break from optimism, from low volatility. Okay, not bad. Not the greatest buy signal because it had already been going up for a while, but still pretty good. It fits what we've talked about today. Okay, so we're going to buy here. And what we're going to do is we're going to plan to lose if the stock falls below our support price. Now, where is support? It's at the last inflection point low, right here. And so if the stock goes below that floor, as it did here, we are going to get out and take our loss. So we put our stop loss at that price. So let's go through the economics of it now. We're going to be a buyer of this stock at $71, and we're going to plan to lose at $64. So our risk per share is $7. If we buy 100 shares, our risk is $700. If we had a $50,000 portfolio, that's a reasonable risk to take. If we have a $3,000 portfolio, that's not a very reasonable risk to take. Not to mention that we couldn't afford 100 shares at $64. Okay, so that's how you calculate your exit point and how you calculate how many shares to buy. So if you're willing to lose $200 and you know your risk per share is $7, then you know you should buy, let's round it off, 30 shares. If you're willing to lose $2,000 because you have a $300,000 portfolio and you're risking $7 a share, you're going to buy 300 shares. So that is the basics of risk management. Now, again, I'm giving you high-level stuff today. I go much deeper into these things in the courses that I do. And we'll go a little bit more into this on Wednesday and Thursday next week. You can learn more about my courses and my tools and my indicators on Saturday next week. I'll talk about those then. Today, I just want to give you a high-level overview of everything. Okay, here's a day trade. In this case, if we are buying this breakout from a predictive pattern, this is called a pennant pattern. This stock is abnormal. This was a stock on Friday that was, again, on my list. And the buy point was right there on the pennant break, just a little after 11 o'clock. At that point, I'm planning to lose if it goes through my last floor price. So this is the buy, and this is the stop. And that price is $2.15, and this is $1.90. So the risk per share is 25 cents. If I buy 1,000 shares, my risk is $250. If I buy 10,000 shares, my risk is $2,500. If I buy 100 shares, my risk is $25. How many shares you buy will determine or is determined by your risk tolerance. Okay, the more risk tolerance you have, the more shares you buy. And generally, the more capital you have to trade with, the more you're willing to risk. But this is a really important thing. Everyone that's starting out in trading should risk $0. Even if you have $1 million, $10 million portfolio, start by risking $0. By that I mean just practice. You know, I can teach anyone how to do this stuff. And again, I'm giving you the high level stuff today. In a weekend, I used to teach my courses in universities. It was a weekend course, Saturday and Sunday, 6 hours of instruction each day. And I taught everyone what they needed to know to do this. Now it's, the power of the internet. I can do this anywhere. So there's people here today that are in Europe. There's people here that are in Canada, lots of Canadians, people from the United States here today. So I can teach this now anywhere. But the point is, it doesn't take a long time. If you're willing to put in 10, 15 hours of work over a few weeks, you can learn all of these things. And then it's just a matter of practice. And that's where you're practicing with no risk. Once you're good in practice, let's say in practice you make $1,000 on paper. Okay, now start trading with a small amount of risk, maybe $50 per trade. And you're successful at that level. All right, you've made $2,000 on paper or with real money. Okay, jump your risk up to $100. Capital preservation is our #1 goal. And although this is quite simple and straightforward, my approach, the one challenge you will have is emotional control, managing your emotions. Seems very simple, but that's the hardest part of investing and trading in the market, is overcoming your emotions. And I've taught thousands of people over the last over 20 years. And I know how I operate. I'm a normal person. I have the same attachment to money. I've trained myself to overcome that. And that's another big part of what I can do for you. Again, we'll talk about that later. So how can I help you? Well, first thing, let's talk about the free stuff. So every week I do a video on YouTube. So make sure you're subscribed to the Stockscores YouTube channel, because I teach a little lesson every week and I analyze the markets for you, tell you whether I'm bullish, bearish, or neutral on the US market, the Canadian stock market, gold, oil, the bond market, Bitcoin. Try to cover the main ones. Now we've got free webinars all this coming week. So today is the first, and then there's the second on Wednesday, on Thursday, and on Saturday next week. In terms of the paid stuff, which we'll talk about on Saturday next week, there's courses for investors, there's courses for day and swing traders. You have access to my tools. I've spent hundreds of thousands of dollars developing tools to find opportunities before most people find them. And you pay a small fraction of that to have use of those tools. You get my support as you're going through the process, and most importantly, support in overcoming your emotional side of trading. And then we have some really cool things that I'll talk about this week. Active Live is a service for day and swing traders, and the Stockscores Market Scan is a tool for finding opportunities. I'm going to use that tool in just a moment. We're actually going to go through the North American markets and see if we can find some stocks that are worth considering for next week. But before I do that, I just want to ask a simple question, and that is if you would like some follow-up information on any of the courses or tools that we offer. I don't like to do high pressure sales. I don't like to bug people. So if you'd like to get some emails from me next week with details of the different courses that we offer, then say yes. If you would rather not, then say no. I'm not going to hurt my feelings. But then I'll follow up with you with some emails and some more details about the courses and that sort of thing. And as we go through the webinars through the week, we'll dive a little bit more into what these tools do and how to use them, and the theory behind them, how powerful they are for finding opportunities. So I hope that you'll all join me for the webinars through the week. I'll show you how to sign up for those in just a minute. But I'll take this poll down in maybe 10 seconds. So just give that an answer as quickly as you can. And if you're watching this as a video, because this will be sent out to those who missed the presentation today, you'll be able to watch it as a video. And you can just, I'll ask this poll each webinar this week. And so you can put yourself on the list for the emails that I'll send out. All right, so I think we can turn that off now. Thanks everyone for answering. Okay. So before we get into the market scan that I want to do, here's the upcoming webinars. We talked about this already. If you want to join in on those, just go to stockscores.com. So this is my website, stockscores.com. Scroll down, and there you can see the links for the other webinars to register for. So if you want to participate in any one of them or all of them, just click on more info and you can register for those. They're free. Okay, you'll see something here, the Active Live. That's only for Stockscores members, people that have taken my courses in the past. All these things, if they have this in orange, that means it's a member only webinar. So if you want to be part of that, I'll talk about how you can be part of that on Saturday next week. But these are the free ones. Okay, all right. So now I promised that we would get into a market scan, and let's do that. So we're going to go to the Stockscores website, go to market scan, and I'm going to build a scan based on what we talked about. I'm going to look for stocks that had an abnormal price gain and did so with abnormal volume. And just so we don't get really illiquid stocks, I'm going to say the stock had to trade at least 1,000 times. And then I'm going to run the scan. And this, at the very most basic level, are 27 stocks that did something abnormal on Friday. Now, this is meaningless so far because we got to look at the patterns. We got to apply what I've shown you so far today. So let's see if we can find anything good. So I click on Go. First chart here is Camber Energy. This is a real penny stock. It's listed on the American Stock Exchange. It has a little bit of a rising bottom. It's not quite through resistance. This is a pattern called a pennant. It's not bad. There's a spike in volume and there's a price jump. Now, based on my skill of reading charts and practice at it, I'm going to say that this has a 60% chance of going up. So I would give it a 6 out of 10. Let's see if we can do a little better. All right, this one started moving on Thursday. Notice it looks very similar, a little over a week ago or on Thursday, like Camber Energy, the last one looked. And on Friday, it actually jumped quite a bit from 21 cents to 30 cents. But I think it's a bit late, and the reason is it's probably going to hit a ceiling up here. And so the upside isn't enough for the downside. That's the risk management component. So I wouldn't buy it now. I maybe would have considered it on Thursday. Next one. All right, here I've got a stock that has had resistance for a very long time right there. It's had rising bottoms, had low volatility. The only problem is you should have bought it here or even here. That was the day when it broke out. It didn't have great volume those days, so it wasn't a super setup. But even still, if you bought on Wednesday at 40 cents, on Friday it was at 50 cents. 25% return so far. But I wouldn't chase it now. I think it's too late. Next one. Okay, this looks interesting. See the abnormal volume? See the abnormal price move? See the rising bottoms? See the compressing volatility? We got a breakout through resistance from optimism from low volatility. Now, when I see something like that, I always like to look at the longer term time frame. So I click on 3-year and I can see the longer term trend. And what I see here is that this stock, something went wrong, obviously. They really had a rough sell-off at some point. I have no idea why, but that's a bit of a negative. So I'm going to go back to the 6-month chart. And I would say, based on what I see, this is about a 6.5 out of 10. So I think it's got a 65% chance of going higher. So it's our best so far. Let's keep looking. Now this, even though it's abnormal, it's not what I want because it doesn't have optimism. It has pessimism. I don't think it's terrible. Like, it is breaking a downward trend line. It did make a double bottom. It might move up a little bit, but I would only give this a 40% chance of working because of all of this pessimism. Go to the next one. And this is the process, is I just zip through charts looking for good chart patterns. Here's a stock that's had a very long base and it started to come alive. Now in this, when I look at the daily chart, I don't really see much, but if I dive in and look at how this stock looked on a 10-day chart, so this is 10 days, 30 minutes, I see that it was boring and low volatility, and it came alive in the middle of the day on Friday, and that tells me that something got investors excited. I think it's okay. I think this is a trade or a stock to maybe monitor more for a swing trade or a day trade next week. I wouldn't consider it for a longer term position trade. So this is more for the people that monitor the market fairly closely. All right, so I'm going to zip through these a little quicker and I'll pause if there's anything that I want to talk further about. This is not bad. This was a really hot stock on Friday. We had it on our day trade algorithms on Friday. You can see on Friday, look at the move it made. I showed this chart earlier. So there was the pennant break. This was Thursday, no abnormal activity. Friday, it starts trading abnormally, breaks from this chart pattern at $2. At the end of the day, it was at $3.60. You don't have to know anything. You just have to know how to read charts and have the tools to find these things in a timely fashion. Okay, this stock trying to break out through some resistance. I'm going to take a look at the 3-year on this. How about the 2-year? Yeah, so the problem here is it's got some resistance right there, which is going to limit the upside. So good, but not great. 6 out of 10. Next one. All right, this made its breakout through resistance a couple of weeks ago. Optimism, This is called a cup and handle pattern. So cup, handle, and there's the breakout, but it's too late now. The buy point was around 240. It's already up to 370, so it's too late. Okay, that one's too late. And this is an important point. When I say too late, I mean it's not breaking from low volatility. It's still very abnormal, right? But when did it start to be abnormal? It started right there. There's the abnormal volume. There's the abnormal price jump. Now it's too late. And this market scan tool allows you to search through the entire market looking for abnormality. Abnormal volume, abnormal price, resistance, optimism, low volatility. Everything looks good on this chart. Let's take a look at the 3-year. Pretty good. A little bit of an issue with where this resistance is from early in 2023. So I give this a 6.5, right around there. Okay. Now I don't want to go through all of these. Well, we may as well. There's not many left. I'll just zip through them really fast. Once you've practiced this for a while, you get really good at it. So I don't have to look at these charts for more than half a second to know whether they're worth considering. When you first start out doing this and you're learning, you're going to look each chart 10 seconds. When you've practiced for a while and you're good at it, you can do it in 1 second each. And so now you see how you've got this process that you can apply every day to find opportunities. If you want to be a day trader, we've got other tools, and I'll talk about those other tools on Wednesday. So on Wednesday, we'll do day and swing trading, and then investing on Thursday. We'll do some market scans on Thursday to find opportunities. If you want to learn how my tools and education work, then you can come join us on Saturday. All right, so I'm pretty much done with the presentation. I'm going to answer a few questions that have rolled in just a moment, and then we'll end for today. But my sort of closing thought is, one of the great challenges I think a lot of investors face is the uncertainty of knowing what to do or maybe not knowing what to do. And what I've developed over the last 30 years is a pretty simple approach to doing well in the market. And it can give you the power and the freedom to overcome that uncertainty, to know, okay, I'm not afraid of a stock market crash because I know what it looks like. I know how to predict one. I'm not uncertain about what stocks to buy because I have a method for knowing which stocks are worth considering, but even as importantly, which stocks to avoid. And I thought this was a nice little thing. I just grabbed this from my email before we started today. This is one of my earliest students. He took my course at least 20 years ago, probably one of my very first students. And I remember this fellow very well. This was back when our course material was on VHS tape, so it just gives you an idea of how long ago this was. But I think the telling part here is made a lot of money from Stockscores over the years, and it gave me a lifestyle I live now, but couldn't if not for that. And this guy continues to be one of my subscribers. He uses my tools every year, every day, and he started a long time ago. And I think that's what this is all about, is giving you something that you have a tool for a lifetime. And so I hope that you will all join in for the other webinars through the week, because I got more to teach you, and I've got an opportunity here for that uncertainty to be taught away, and so you can sort of take command of the market. So with that, I will answer a few questions here. Do you move stop up as stock climbs? Yep, as the stock is climbing, we move up our stop based on a method called the reward for risk lines, and I have to go through that, and it's an hour-long lesson in our course material. Do you have a recording of next week's webinar? I record all of these webinars. I think it's best to watch them live, because then you can ask questions. But if for some reason you can't attend on Thursday next week, register. And if you're registered, I will email you the link for the video. And so, yeah, and today's was also recorded, so you'll be able to go back and watch this as many times as you need. I'll have the email out to you probably later today with the link to the video. Sell signal based on which time frame? So generally we sell on the same time frame we buy on. So if you buy on the daily, we sell on the daily. The only exception to that is when the stock goes parabolic. So if it really starts to go up fast, we might shorten the time frame, but generally we buy and sell on the same time frame. How does a person buy and sell an ETF? They're bought and sold just like a stock. So you have a brokerage account with, most people have a brokerage account with their bank, and you buy it just like a stock. So if you wanted to buy the Toronto Stock Exchange, the ETF for that is XIU is the symbol. If you wanted to buy the S&P 500, the symbol is SPY. You can do a Google search for ETF list, and there's hundreds of them. So you can see there's an ETF for everything, for the price of gasoline, for the price of Bitcoin, for the price of gold. And then there's leveraged ETFs that move quicker than the underlying asset. So you can have a leveraged version of the S&P 500. The symbol on that is SSO, and it moves double the speed of the S&P 500. So there's lots of different ones. There's triple leveraged, all kinds of things. But there's things to know about that too. And, for example, a leveraged ETF can really be dangerous if it's going against you, because the leverage means you lose faster as well. And there's this value decay. So you shouldn't just blindly buy ETFs without knowing a little bit. But again, those are the kind of things that I teach. Okay. Sorry, there's lots of questions and my screen is scrolling, so it's a little challenging to see everything. What chart timeframes do you recommend for a person who wants to check their trades daily, not 2 to 3 times per day? So then I would trade off of the daily chart. You only have to do your checks in the evenings. Does any of your trading cover options? I have an options module. I'm not an expert in options. I'm an expert in the stock picking. Many of my students use options to leverage their performance, but I don't. I teach the basics of options, but not much more than that. Do you add to positions? Yep, that's something called scaling in. So I have a whole module on scaling into positions. Just checking here. So we have someone from France. Cool, enjoyed the presentation. When looking at resistance as an issue with upside progress, how far back do you consider? So the idea is here is how far back is resistance important? So generally, when I look at a position trade, I actually look at a 3-year chart. When you're day trading, it's actually less important because abnormal stocks can plow through resistance. They often fall back before the end of the day, but you can be in and out by then. But if you are doing, longer term investing for your retirement portfolio, let's say, I would look at the daily chart and the 3-year weekly chart. On the 22 century stock, the stock quickly went parabolic. Would you have sold and then bought back in after it dropped? Yeah, there was, on that particular stock, which was the symbol of CADL, there was 3 buy and sell points that day. So it's not necessarily that you held the stock all day long. You could have if you were using a very relaxed exit approach, like more off of the swing trade setup. But for the day trader, it was in and out at least twice, maybe even 3 times. Is there a minimum of trades you look at daily, monthly? Is it important? Well, liquidity is important. So, if I'm position trading, I want to see the stock trade for a Canadian market at least 200 times a day, maybe 100 times a day. For the US market, that's more like 1,000 times a day. But if I'm day trading, I actually want to see a minimum of 10,000 trades per day. The message of the market is more reliable the more times a stock trades. Question for swing trades, how many times a day do I need to check market? Most of the swing trade entries come in the first hour of the day. And so, for my swing trades, I'll buy most of mine in the first hour. And then, let's say I got to take one of my kids to school, or I want to go out. I can monitor my positions from my cell phone, and I don't have to monitor that closely. Like I check them a few times a day, decide if I need to move my stops based on how things are going. And then that's for swing trading. Now, day trading is more time sensitive. And so if you're day trading, you kind of have to watch all day long, or at least a lot of day trades run and they're up and down in the first 2 or 3 hours. So you could do that. Position trading, you need to check your stocks once a day or once a week. And I'll talk about those things in the presentations on Wednesday and Thursday. We'll go a little deeper into some of the stuff. What is your recommended broker for swing trading? I don't really recommend everyone. I can tell you that I use Interactive Brokers. I don't think Interactive Brokers is for everyone. It's a good option if you are fairly good with computers, because it's a software app that is, it does a lot. So if you're less inclined to mess around with computers and sophisticated software, then you'd probably just want to trade through your bank, because they all have their online brokerage service where it's just through a web page. It's pretty simple. But I use Interactive Brokers. I think they're good. They're not perfect. Now I know I've missed a bunch of questions, so are most of your day trades with stocks under $10? I would say most are, yes. I look at everything, but the reality is most of the stocks that are really big movers, that are really liquid, abnormal stocks, they're usually under 10. But I mean, I've had some in the last month that were 50, but not many. Most are under $10, yeah. Once you find the stock, then you check the fundamentals for day trading. Do you have different rules for day trading and swing trading? So I never check fundamentals. I only look at charts. The chart is an interpretation of fundamentals, but it's not something I ever look at. In fact, I find it destructive to know what a company does, because when I know what a company does, let's say I know that they're developing a new drug. Well, the tendency then is to get emotionally attached to that company's story, and then you ignore the message of the market. So I actually really dissuade people from knowing too much about the companies that they play, because it'll cloud your judgment. And everything you need to know is in the market action. If there's something wrong, the stock will start to go down. Where can I practice? We have a simulator at tradescores.com, which is free to use. You can just practice with a piece of paper and a pencil. Just write down, I would buy here, I would sell here. Excel spreadsheet, good way to do that. Do you offer a managed portfolio? No, I do not. I teach people how to do it so that they can, be in charge. No one cares more about your money than you, so I really want people to be empowered to look after this themselves. I will teach you and give you everything you need to know, but you still have to do the work. All right, I know that I've missed a few questions, but I think I'll end it there. And if I've missed something that you really wanted to know, please email me. My email address is tylerb@stockscores.com. I may have that on here. No, I don't. Tylerb, Tyler, B as in Bravo, @stockscores.com. And you can get a hold of me that way. All right, so I hope you have enjoyed the presentation today. Again, make sure you're registered for the other webinars through the week, and I will see you on Wednesday. Thanks, everyone, and have a great rest of the weekend.